I always like checking in with Mark Perchtold. He is a Joburg boy who's now living in, has been for a long time in the UK, in London, in the financial capital of the world. And he plugs us into what's going on around the world, what's going on around markets, and how we should be interpreting this for our own investments. Mark is also the founding director of OMBA Advisory and Investments. Good to be with you again, Mark. We've had quite a lot of volatility in the markets last year, crazy losses that people have experienced on their portfolios. Now, you guys at OMBA specialize in using exchange-traded funds. You analyze, how many of these are there?
Globally, Alec, there are over 8,000 now. And in the European landscape, in the UCITS world, there are over 2,000. So the landscape is huge. Just picking a random ETF is becoming more and more difficult for the average investor.
And how? We've actually got some in our own BizNews portfolios, and I'm wondering if we've got the right ones. I was talking to Sean Pesh the other day, who said he thinks that value is now the place to be. I think a lot of investors do, and we'll talk about value and growth and the difference in a moment. But he said not necessarily the one you've got, which is the Vanguard Value ETF. He said it's not really a value ETF, even though it's called that. That sounds strange to me.
Yeah, it's a good point that Sean makes. A lot of these factor or smart beta ETFs, as they're called, will follow a particular factor like value or momentum or low volatility or quantity, for example. And so they'll overweight stocks that exhibit those qualities like value, being low price to earnings multiples or price to book multiples or whatever multiple you want to look at, for stocks that trade cheaply or perceived to be cheaper. But they're often sector neutral, which means they want to maintain a diverse sector exposure. So they're not necessarily going into value sectors. They're actually keeping exposure to all sectors within a broad index, but they're owning all the worst stocks in terms of recent performance and often therefore more attractive price to earnings ratio, price to book ratio. And so you don't always get what you expect when you follow these factor ETFs. And we've looked at this quite closely in recent years, because at the same point Sean makes, we noticed that some of the factor ETFs, like the value factor, didn't often give us the value exposures we wanted. And so we've started to change our thinking on it to really understand what's inside those value or quantity or momentum factor ETFs, and perhaps instead own value sectors. For example, the healthcare sector is often more defensive. So if you want more defensive exposure, you might move to healthcare and pharmaceuticals, for example. Or we're looking at value. Something we've done in our portfolios recently is move towards European auto sector, because it trades really attractively from a valuations point of view. It's got strong price to cash flows, price to earnings ratios. A lot of people have priced in a recession. And people, when there's a recession, they might replace their toaster, or their kettle, which they have to, and it's a small ticket item, but they're not necessarily going to replace their car. And so the auto sector tends to get beaten up a little. And so we've liked that sector, trades cheaply. It would exhibit value characteristics in our view.
That's really good insights. And another thing is another one of the ETFs that we have in our model portfolios is the European financial ETF. So it's called the iShares MSCI Europe Financials ETF. And this was after Koki Koiman said the European banks are cheap. Now, I don't know if we've really done the right thing there. If we're trying to buy into European banks and you get the MSCI Europe Financial ETF, and I started looking at it, it's got property and insurance and quite a few other things. So just selecting an exchange-traded fund, you've actually got to look what's in the tin rather than look what's at the name.
Absolutely. We believe in that strongly. And also stacking similar ETFs against each other. There are often many financials ETFs, and there definitely are in Europe. So there might be 8 or 10 in your universe. Which is the best one? Do you go with the cheapest one? Do you go with the one that's got caps on them, on the weightings, for example? One that's equally weighted, one that's market cap weighted, one that's got certain geographic mix. Often the headline is not necessarily the way in which you should choose. Well, certainly not the way in which you should choose the ETF. You should look underneath the hood So we've built tools to do that. We can look at 8 or 10 or 50 ETFs stacked against each other and look at the underlying metrics. But it's interesting on financials. Financials have traded cheaply in Europe for a very long time. And I think will continue to do so. Just an interesting random fact here is that Deutsche Bank, for example, have issued, in terms of rights issues, more equity capital than the entire current market capitalization in the post-GFC period. So if you've been a shareholder, you've had to participate in every single rights issue since GFC to own the current market cap.
GFC being?
The global financial crisis that occurred in 2008 period, 2009. So one has to be quite careful with financials in Europe. I think they trade cheaply from a traditional valuations point of view, but they trade cheaply for a reason. Many of them have legacy, poor performing assets and loans on their balance sheet that might need to be written off because people aren't going to repay those loans. Their business models are often questioned. There's been lots of disruption from fintechs and people leaving big organizations to set up competitive firms, whether it's in the money payment space or it's in the investment management space or the wealth management space. There's been lots of disruption of banks over the last 10 years. And also, with low rate environment that we've had for a very long time, banks have struggled to earn a margin on the terms of their deposits versus what they lend at. And furthermore, and probably the biggest thing is financial regulation. So post this global financial crisis, to protect mainly retail investors around the world, regulations got much tighter. And those tighter regulations have put a huge burden on banks in terms of, one, the business they can do, but also the cost burden of adhering to those regulations. So I actually don't like European banks at all, and would not be a trade that we'd recommend putting on. And insurers also differ vastly from, traditional banks. So they're financial services, and you'll have insurers in the ETF, but insurance businesses are completely different. They've got all sorts of other things to worry about, like asset liability matching. They would have been hurt from the changing interest rate environment of the last year. They get hurt when there are catastrophes and increasing floods in the world and fires and earthquakes and all sorts of natural disasters. They hurt insurers. So the insurance businesses are very different to banks. And so you actually have to understand what you buy when you buy these ETFs.
All right. So you're already making me think we're going to have to make some changes in our portfolio. If we start with the Vanguard Value ETF, and we want to ride this new wave, growth being having been in fashion for a couple of decades, and value being out of fashion, but it now seems as though things are going to change again. Would you then be talking about rather going for those very cheap sectors like, as you said, European autos?
Certainly, I think in Europe, one of our top picks is autos. We actually overweighted Germany last year because the German market, the DAX 40, sold off meaningfully because of concerns about obviously what was going on with Russia, Ukraine, the impact of higher energy prices on input costs for big German industrial companies and the like. But it traded very attractively as a broad index of blue chip multinational companies that sell to the rest of the world, but was beaten up. So it exhibited value characteristics in aggregate. And so we bought the DAX. We've now recently started to think about removing some of the DAX, moved our portfolio a little bit more defensively because it's performed well as we had expected. And all these concerns about high energy prices and the impact on Europe have not unfolded to the same negative degree as expected. It certainly had an impact, but it's not been as grave as expected. So I think looking at sectors and countries that exhibit cheapness is one way to go about it. But value is also in the eye of the beholder. I think people get caught in this value trap. Companies trade cheaply often for a reason. Business models defunct, the company's losing market share, competitors have entered a market, the landscape has changed. And just because something trades cheaply, it doesn't mean it's good value. It may trade cheaply, but it's trading cheaply for a damn good reason. So I think you need to look at growth too and consider, what is growth at a reasonable price? That's good value. If you pay for a company that's growing, disrupting, doing positive things, generating cash flows, expanding, entering into new markets, developing its product suite, that's good value for money. If it's not trading at too significant a premium. So I think investors tend to get caught in this growth versus value mindset incorrectly. There's a constant growth at a reasonable price, GARP, is something we ascribe to and like, but we are traditionally value oriented. We don't want to pay 100 times earnings or pay 100 times revenue for a company that's never turned a profit. A company that's never turned a profit, in my view, I don't think they should be, necessarily in capital markets raising money at the ridiculous multiples they do, because they haven't demonstrated a business model that can stand on its own 2 feet. So that's a debate you have in the value growth story. But I think people get caught in this concept of value. Value is good value for money, as opposed to trading at a low multiple value.
It's so interesting when you start looking beyond what Howard Marks calls the first level thinking. You quickly see that there's a heck of a lot more complexity in the investment markets, as you were already unpacking, and we've hardly dipped a toe in the water. But moving on then to the way that you guys are seeing the markets at the moment and the way you're structuring your portfolios. When we spoke in November, you warned about volatility. We have seen a big rebound in stock markets during January. I think it was one of the 9th best starts to the year in the last 60 years. How are you reading the rest of 2023, and how are you positioning your clients' portfolios to take advantage?
We joked at the end of Jan that maybe we should just move 100% to cash and claim the performance for the year, because was that the year, if you ended the year up that much, it wouldn't have been such a bad year. But the reality was, as we were saying last year, that markets tend to get oversold, and similarly they tend to get overbought. We're certainly not necessarily in overbought territory if you take a long-term view. If you look at major markets around the world, from all, looking at the value of price to earnings, price to book characteristics, they still trade reasonably attractively in terms. So despite the move up, your price to earnings ratios aren't that high across most major markets. So it's not necessarily a poor time if you cash flush to start entering into the market. However, it's certainly been a very strong bounce. November was exceptionally strong. January's been exceptionally strong. We've come off lows. The way we've positioned our portfolios, as I'd mentioned last time, we'd started to accumulate more large cap US technology, and many of those big counters have really started to rebound. We're currently this week and next week making some decisions on this, debating whether to lighten up some of the US tech exposure we took, given the very strong moves very quickly. That's one of our debates. We've also done well in overweighting parts of Europe like Germany, and that's already been a decision we've taken to remove Germany in favor of subsectors within Germany, which include autos. And then China has been a position we've been overweight. We've weathered the storm, and it's now rebounded. Fortunately, I think the China reopening is potentially very positive for the world, as you've got this Chinese consumer which has started to grow. Very differently from the China of 10 or 15 years ago, which was driven by investment and Chinese government investing in infrastructure, in new roads, new rail, building sky-rise buildings everywhere and housing. It's now actually got a big consumer, and that consumer is growing. And so when China opens up and there's pent-up demand, and one of the things we're looking at, for example, is tourism across Southeast Asia. If you look at Thailand and Malaysia, inbound tourism from China has absolutely skyrocketed. So then we're looking at Southeast Asian countries and saying, hang on, can we capture some of this China reopening story through the tourism sector? But the Chinese reopening story's got massive implications for the rest of the world, because that consumer in China will now start to buy goods from elsewhere, and they can now supply the rest of the world, where a lot of supply chains were somewhat broken because China was locked down, which again will bring in inflation. So I think the China reopening story, coupled with the fact that employment data in the US is still strong, the US economy is looking okay, actually sort of could paint a positive picture for how the year unfolds. A lot of bad news was priced in last year about how the war would unfold, the impact on energy prices, our companies were going to struggle and lose money and all the rest of it. And it hasn't turned out to be that bad. So there's a positive view to be taken from that. But we're worried about maybe the back end of the year, because the forward market, which predicts where interest rates will go, and you think about the Federal Reserve and their base level of rates, is implying that Federal Reserve will cut interest rates by Q4 or so. Now, the Fed themselves have said they will not. So the market anticipates that the economy might be that weak that they have to respond by loosening monetary policy and cutting interest rates. And so the market's implication of the future is different to what the Federal Reserve is actually saying, which is a bearish indicator, the market is saying. So I think, the strong rally is great. I don't think we're necessarily done for the year. I think there's an opportunity to capture more upside as we move through the year, but there's going to be noise. So difficult is the answer, Alec, but not taking all risk off.
There's also quite a strong theory that's met the test of time, that you buy when the interest rate cycle peaks, in other words, when interest rates start falling, and you sell when interest rates start rising. Well, had we all sold when interest rates started rising last year, we're talking about shares or equity markets, we'd have been a lot more comfortable than most of us are today. But this interest rate cycle right now, where do you see it?
Well, in terms of, the major developed markets, China's uniquely in a position to cut rates, and they're the second largest economy in the world. But if you take other big blocks like, for example, Japan, which is starting to see inflation, and they've started to allow their interest rates to rise, which is, very unprecedented in recent decades for Japan. If you take the European ECB and the Federal Reserve as the two major other central banks, they're in a similar place, really. They're still trying to fight inflation. They have indicated they're getting closer to a peak level of rates, but the Fed have said that they're likely to stay flat for a while. So once they've reached the peak, they'll keep interest rates flat and then maybe start to cut as inflation comes in. It's all going to be driven by the inflation data, ultimately. And there are different camps on inflation. There are those who argue that we're far from done on inflation. Inflation continues to run hot, and they haven't moved enough yet, the big central banks. And there's the other school of thought that sits in the deflation camp that's saying, actually, given all the changes that are taking place in the world now, China reopening, supply chains post-COVID, no longer such a big issue. Shipping rates have come down massively. Demand is softening as economies somewhat cool, and fears of recession, etc. That inflation is not going to be a problem. Energy prices and other commodity prices have come in from the highs of 2022. So we could actually see a deflationary world. I think we're somewhere closer to low inflation, not necessarily deflation, than we are to high inflation. And so inflation is coming in. If you look at the year-on-year readings, and even the month-on-month, the January reading in the US was 0.41. So if you annualize 0.41 every single month, you're looking at, 4.8%-ish inflation. That's not that high. It's higher than the target of 2, but it's not where it was north of 10. And so inflation has been coming in. I think as interest rates have risen, it's going to squeeze households. If you've got a mortgage, you've got a student loan, you've got motor vehicle finance, you've got your company and you've borrowed money, you now have to repay at a higher interest rate. Or if you need to borrow, you're going to have to borrow at a higher interest rate. And that's going to squeeze the economy. And so that will then drop demand, and that dropping of demand will cause prices to decline. So I think the Fed there's this argument the Fed might have done it perfectly, and there might be a soft landing. And I'm somewhat in that school of thinking based on the economic data. Employment data is still very strong. They've moved rates up meaningfully, and inflation is coming in. So where we are in the rate cycle, I think we're getting close to peak. I do think within a year or so, you could potentially see cutting as the economy slows down and as inflation comes in.
And then the way you're positioning your portfolios for this?
So it's interesting. We've actually taken advantage of some of the high yielding rates in terms of fixed income component of our portfolio. So we've been owning the 1 to 3 year treasury part of the curve, which has paid you quite attractive short rates, versus holding cash. Okay, so let's just say cash was your starting point. And more recently, we've started to move into emerging market dollar bonds through an ETF. And that's driven by, we've held them in our portfolios, but we're increasing our weight. So this is emerging market dollar paper. And that means you're not taking currency risk because you've got dollar. So it's the dollar bonds of emerging market countries. Interestingly, many of these emerging market countries are actually classified as investment grade. So it's different to owning US dollar-denominated high-yield or junk bonds, which are also dollar-denominated high-yielding, but they're all junk. They're all sub-investment grade. You're actually owning bonds which are, to some degree, investment grade just from emerging market countries. And so you'll have a lot of Middle Eastern countries, you'll have many Latin American countries, you'll have European countries, you'll have these emerging market countries issue dollar bonds. Many may default, but most won't default. and you don't have currencies, but you're getting paid a handsome spread over owning treasuries, for example. So that spread, and the spread over high yield as well, in US high yield, is attractive. So, fixed income, that's one of the things we're doing is looking at emerging market dollar bonds.
Mark Perchtold is founding director of OMBA Advisory and Investments, and there you've got your update for the month or so. Look forward to picking up with Mark again in the near future. And I'm Alec Hogg from BizNews.com.